Right. I think we can begin now. We have around 50 participants and the others can probably join when they can. So, right. Yeah, we'll just start it in a bit. So, good evening, everyone. Welcome. My name is Nikhil Javadi, and I am a fourth-year law student at National Law University, Odisha. And I have with me Naman Ostwal, who is a third-year law student at NLUO. And we would be hosting this season's premiere of TechTales. Now, I welcome all of you to the premiere episode of LexTech Center for Law, Entrepreneurship and Innovation's talk show series, TechTales from Code to Courtroom. Now, in this talk show, what we will be doing is we invite industry experts from fields like AI, FinTech, TMT, data privacy, online gaming, and other such related areas. And let me tell you why this talk show is one of a kind. NLUO is the first national law university to cover these topics in such a format, which makes this talk show really unique. Now, as far as technology and AI is concerned, I think all of us are pretty well aware that the revolution of ChatGPT and AI and its intermingling with the law is in fact where the future of the legal industry lies as far as LexTech is concerned. Now, with the exponential growth of accessibility to technology around the world, technology and law, in our opinion, have a symbiotic future. We live in an age where machine learning algorithms can now identify patterns and predict legal outcomes. AI-powered chatbots and virtual assistants are able to offer immediate legal assistance to the public. And there have also been an increase in access to justice via technology. In fact, this is why Thomson Reuters in their 2020 report said that nearly 85% of the attorneys across the world were already using AI tools for legal research and case law analysis.
Am I audible?
Yes, you are.
In this talk show, the experts we will be hosting over a series of multiple episodes will discuss the recent developments in these 5 emerging areas of law and technology. Also, they will deal with the various legal concepts in these areas by explaining the relevant laws and regulations involved. The talk show strives to inculcate curiosity among the viewers in what we at LexTech believe is the future of legal profession. The sessions will be conducted online via platforms like Zoom and streamed to the entire student body. It will also then be uploaded on our YouTube channel, so you can still catch the episode if you miss it live. It will be an interactive session where the floor will be open to questions at the end of each episode.
Thanks, Naman. So, as Naman mentioned, even if you do miss this episode, you can definitely catch this again on YouTube, which it will be uploaded as soon as the session ends. Now, with that, we welcome you all to the premiere episode, Season 1, Episode 1 of TechTales from Code to Courtroom. And in our season's premiere, we have Amit Maurya, sir, with us. Good evening, sir.
Good evening. Pleasure to be here.
Thank you so much. I hope you're doing good.
Yes, and thank you so very much for inviting me for this, especially to everyone in the team. And this is one thing that comes to my mind is that there's an extremely nice initiative by the student body, and the way FinTech's been sort of emerging and evolving on almost a monthly affair. It's quite important that someone takes heed of that, and I congratulate everyone on this.
Thank you so much, sir. So Amit Maurya, sir, has graduated with a BA LLB honors degree from Christ University in 2018, after which he started his career as an associate with Indus Law. After that, he switched to Cyril Amarchand Mangaldas, where he was an associate for 2.5 years. Now, while at CAM, Amit sir was a part of the firm's general corporate practice at New Delhi and the FinTech corporate finance practice at Bangalore. Amit sir has also been a part of 3 FinTechs till date. Firstly, he was with Ampli Wealth, which is basically also known as Kachao, which is a wealth tech-based FinTech. After which he was with this one FinTech by the name Pay with Ring, also known as Kisht, which is a leader in the digital lending segment in the Indian market today. And right now, sir is a part of Cashfree's legal team, which is a leading payments FinTech in India. Welcome, sir, to the show.
Thank you again.
Thank you. So in this episode, viewers, we will be covering 4 major topics as mentioned in the brochure that was circulated among the student body. First, we will talk about what exactly FinTech is, and then we will discuss its evolution and regulatory history. Second, Amit sir will talk and in fact decode what digital lending is, and with reference to the new digital lending guidelines that have come up by the RBI in September 2022. And he will also be covering the buy now pay later models, which is a very big thing in the market right now. We will also be touching upon the concept of first loss default guarantees, the FLDG framework that was recently released by the RBI as well. After which, we will then move on to the third part of our talk show episode, where Sir will talk about the regulatory compliances for fintechs with respect to KYC, know your customer, as well as the storing and processing of financial data and how exactly fintechs are trying to address these data privacy concerns. And finally, we will be opening the floor to the audience to ask some questions in the last 10 minutes of this episode. Unless there are any questions, Amit sir, or any remarks at this point, I would like to begin.
Sure, we can go on.
Thank you so much. Without further ado, let us begin. So I think first off, Amit sir, in my recent internship, I recently interned with Khaitan & Company's Bangalore office, where I was exposed to a bit of fintech research during my time. And what I found was that the concept of working as a lawyer in a fintech firm is completely different. The role itself is completely different to what we see in a traditional law firm. And I think this is something that you would be able to throw a better, I think you would be able to answer this better in the sense that how is it different from being in a law firm to the legal team of, say, a fintech app? So how is it working in a law firm different from a fintech company's in-house role?
Great question. So, just to put my initial thoughts, a lot sort of in a product company or in a fintech company, a lot is centered around the product, right? Whereas while you are working in a law firm, you are trying to address certain legal questions and queries and certain questions of law and try to help your client, while being aware about their business to an extent that they would probably tell you over calls and meetings and everything else. Whereas over here, you have like a very deeper insight about how the product is supposed to be made or functions and everything else. So right from ideation or conception of the product to that of structuring, again to the release, the post-release nuances, a lot of operational issues that can happen. Everything bang on falls on you from a legal perspective. Or from how it can be addressed through legal concerns and everything else. That's one of the very prime differences. The other side is this, that you get to work on the commercial side more, and that's very, very important. You get to be very, very, if I can say, customer centric and product centric, while ensuring that the legalities and all are fine-tuned, but the product market fit and everything else is also sort of taken care of, right? You have to be you have to know the product from a business point of view, from a sales point of view, from how it can be operationally, how can it work operationally and everything else. So, and back at a law firm, you would probably have very limited insights as to the working of the product and, everything around that. So having said that, yes, that's one of the core differences that one can, particularly sort of point it out.
That's definitely answers the question. Coming to the first topic of discussion, sir, can you explain what is fintech and how it has evolved over the years?
Right. So, see, fintech, as the name says, right? Fintech is an amalgamation of financial and technology services, right? If you were to look at it from from a traditional sense, then one can probably argue that net banking coming in say like 98 by ICICI Bank, then phone banking, SMS, mobile, and now application based banking and other financial services. All of that can probably be categorized as fintech. But rightly, I'm just in the generation or in the decade that we are in, and the prior decade to this, fintech is primarily stood for disruptions, right? So how solidly have you been able to disrupt a particular financial service? That's the core idea or the intent behind being a fintech. For that matter of fact, look at some of the leaders. Uh, Paytm, PhonePe, Razorpay, all of these entities that you can think of. They have, in the traditional and in the non-traditional way, both have been able to disrupt a lot, and they've been able to bring forth financial services in a way and manner that probably we did not think a decade back, right? Or maybe like 10 years back. So that's what probably today fintech falls for. Nikhil was mentioning a lot of statistics. Let me throw up some more statistics. The market size today for fintech in India is around close to more than $150 billion. It was only $50 billion, by the way, in 2019, right? The and the best part of it is this, that our penetration still remains as low as maybe 10% of the population, correct? That too, out of your 10% can be your total addressable market, but out of which how many people are actually using it is significantly lower than that. And still we happen to be one of the just I think after US and China, we are the biggest fintech ecosystem in the world. And on top of that, we handle 40% of the global digital transactions already. So that's a data wherein which we have, while we have not been able to provide fintech services to everyone possible, right? On the population scale, and possibly it's less than 10%. So imagine the scale, and the arena so big, and the platform that it can, as a population it can cater to. So that's quite huge, and that's something that what fintech aims to. How can it disrupt? How can it make sure that a lot of people get onboarded? How can they have a lot of financial services at the, as you nowadays say, on an app's go? So yes, that's something what fintech aims at. I believe, yeah, these would be my primary, take as to how fintech is sort of evolved over the years from a product perspective. From a regulatory perspective, earlier RBI was at the helm of affairs. Now a lot of other regulators have come in, including NPCI, and even to an extent the Ministry of Finance, and now RBI has like a dedicated department for fintech in its whole, the whole organizational setup that it is. So yes, that's how I would sort of say that fintech has now evolved over the past 5 to 10 years.
Definitely, sir. The fact some of that how big fintech sector is, and it is going to be in the future. But talking specifically from a legal perspective, how have the fintech companies been regulated over the years? And fintech is a growing field with a lot of new services entering the market. So, what are the current legal frameworks that regulate these companies?
Right. So if you were to look at it, then I think the best way to look at fintech is to segment it into a couple of broader categories. So one would of course be your digital lending, because that's been the one of the primary, uh, if I can say, primary fields in fintech that has sort of evolved to a great prime now. The other side has been the payments ecosystem, right? Wherein, your typical Razorpay and Cashfree of the world would fall in. By the way, just to give a loyalty disclaimer, anything that I say over here or any views that I share will not belong to my employer, current or the previous ones. We are all lawyers here, so that needs to be coming. The other thing is also this, that you also need to look at other platforms like InsurTech, WealthTech. WealthTech would be your typical Grows, Zerodhas, and all that. InsurTech would be your insurance technology enablers, which are now sort of getting aligned to a lot of these apps, so that insurance is a push product, right? Nobody wants to buy insurance at the first go, unlike like a loan, wherein you would probably prefer to always seek out for a loan. So that's there. So primarily these 4-5 main buckets. If you look at it, how is digital lending regulated? RBI digital lending guidelines came in last year. Ministry of Finance to an extent, FEMA regulations and all of that would be very, very important. If you were to look at the payment side, NPCI is taking a lead in terms of UPI, BBPOU, Bharat Bill Payment Systems and all of that. So those core regulations remain to be something that is there. The KYC directions apply nonetheless to almost all entities which are regulatorily required to take a KYC or to track their customers' transactions and everything else. There are credit information laws. Now that's very important because there's a whole segment called as credit information companies, right? Through which you get your data, or through which you get an salaried individuals or non-salaried individuals to a great extent that they can put up a credit score, right? And you fetch those details so as to gauge as to which person needs what type of a product, right? So that's again the account aggregator ecosystem is sort of is a regulatory whole thing. There are regulatory sandboxes. I think 4 cohorts have already taken place by RBI. So the RBI allows you to give certain amount of freeway in trying your product out in a sandbox, and then probably release it out. So a lot of regulatory headwinds can probably be anticipated, and you need not always take it as a headwind when you are in a sandbox. So a lot of these regulatory structures are regulatory paradigms sort of govern these different ecosystems. So if you're in the insurtech platform, so IRDAI rules would, in addition to all of these, also apply to it. Correct. So it goes sector by sector in a way, and we'll have to sort of analyze each sector and what laws apply to them. And it's always better that one, if you are interested into fintech, that you keep a track and be a little bit abreast on all of these evolving nuances on each of the sectors, because they are highly correlated, right? So a KYC thing happening, the master direction by RBI, which keeps on getting updated every now and then, that would affect players from a lot of different sectors, right? Even if you were to look at the digital lending sector, you can categorize it as B2C and B2B, correct? Wherein you are taking a loan being as an individual customer versus some business entity taking a loan from an NBFC, right? So the latter would fall into a B2B, the former one in a B2C. So yes, that's how probably the whole, regulatory framework has sort of been aligned to different segments of fintech, if I can say so.
So I think basically what I've got from whatever you said till now is that I think people make the mistake of thinking of fintech as a practice area, as a specific practice area of law. I think that's the fundamental mistake, because fintech hits here. As you mentioned, there are different industries in which fintech has been used. For example, insurtech, it's a culmination of the insurance industry as well as finance and technology. If we look at wealth tech is again there's capital market. So players like Zerodha who help in essentially products like Kite, where you can invest in stocks on an app. That's essentially combining the capital markets or the financial market structure of India with technology.
So you cannot ignore your SEBI laws onto those products, right?
Yeah. That is something we've covered in law school. But essentially, I think looking at it that from not from I think for the legal perspective to kick in and to talk about fintech from a legal perspective, I think we should first understand the market itself and understand which market this particular fintech player is playing in. So if it's a fintech company that is playing in the insurtech sector, it will have RBI guidelines as well as IRDAI regulations in play. So that's I think for my clarity, that's what I've been able to get so far.
That's precise, yes.
Please, Naman.
Yeah. I have a very highly debated question for you right now. So with multiple people having multiple takes on it, but what is in your opinion? Is the current regulatory burden too high on fintech companies?
Okay, now so that's again ongoing, tussle. A lot of newer entrepreneurs would probably argue that regulations are always there as an impediment, and that's not just from our jurisdiction, right? Anywhere you take that model, a lot of Hollywood films also would probably tell you that a lot of regulations are rather seen as an impediment. If you were to ask probably the loyalty community, a lot of them would say that no, a lot of aspects still needs to be regulated. So it's quite an ongoing thing. I can give you certain examples, right? So for instance, take Slice, Uni, and all of these products that were there, right? And they were selling PPI wallets being filled up with credit lines. So it's like saying I open a Paytm account for you, right? Or like a some wallet for you, and then fill it with a credit line, and then that suddenly becomes a threat to the whole credit card ecosystem, right? So because of the fact that the banks have been giving credit cards for quite some time, and they have the licenses to do that. And a lot of due diligence goes on to distribute credit cards. So that sort of a disruption which comes in through a loophole in law would probably be plugged in by the regulator, right, and rightly so, right? But if you were to look at probably certain other areas of law, like for instance, data privacy and everything else, fortunately, we have a bill which has got tabled now. Those areas remain to be unregulated. So yes, like it's an ongoing tussle, and it keeps on happening to and fro by a lot of means and measures.
Thank you, sir. Yeah, so I think with that, we sort of now have a rudimentary understanding of what exactly fintech is and how to look at fintech and how we've classified fintech into these 4 to 5 broad practice market industry areas, in fact, if I were to put it that way. Now, I think moving on to the second part of our session, I think at this point, I think what you said, sir, is that if we talk about fintech, one of the major things that first comes to mind is the digital lending ecosystem and the buy now pay later ecosystem, which are, I think, in my opinion, as far as my research holds me good, and I think I can hold my ground on this, that BNPL and digital lending is, I think, one of the 2 core services under the fintech market as a whole. I think all companies are either a digital lending ecosystem, they've adopted a digital lending platform to sort of facilitate transactions online, or it's a BNPL or a loan-based. It's either a credit-based model or a debt-based model, essentially. That's what I make of it. But essentially, we also know, sir, now that with the advent of the neo banks and the online banking structures, with ICICI Bank having introduced it in India, there has been a lot of increase in the digital connectivity of customers itself when it comes to banking services. Now, for example, if I have to take a loan today, I don't need to go to the bank. I can schedule a meeting through one of these fintech companies. I can take a loan through any one of these fintech companies. I don't even need to go to the bank. In fact, even opening an account on a bank. So, for example, as far as I know, there's this one fintech app that I was just playing with the other day called FiMoney, where they've collaborated with Federal Bank. And essentially, I tried to open an account on that. They asked for my Aadhaar verification, and then the bank, there was a resource person from the bank who had a video call with me, and they verified my details, and then I've successfully opened an account in Federal Bank. I think this example, why I'm quoting it, is because this is something that we are very familiar with, but I think someone from, say, my dad's generation, and I think even you, sir, in your earlier days, opening an account or, say, getting a loan from a bank was a very big thing back then, and now it's happening at the I think it's happening on our fingertips, and that's all because of the technology and AI revolution in financial services. But I think with that background in mind, now again, coming back to the law, since we are law students and aspiring lawyers. So I remember, so that I think around a year back in September 2022, the Reserve Bank of India, RBI, had brought out guidelines for digital lending, which was, I think, an ask from the stakeholders and the market participants for a long time. I think RBI did delay on releasing these guidelines. But, sir, in your opinion, what do you think was the objective behind it, and how exactly have these guidelines, in fact, impacted the market? How does the market sort of metamorphosized and adjusted to the laws 1 year down the line? Because I think September 2022 is when the digital lending guidelines were released, and we're in August 2023. So it's been a good 1 year, 4 quarters for fintech companies. So from a market perspective, how do you think they have sort of adjusted to the digital lending guidelines?
Correct. So that's another very good question. Let me try to sort of answer it in a chronological format. And before that, just give a broader overview of the digital lending segment and the products that have sort of, developed over time. So see, lending has existed for thousands of years now, right? So what is digital lending? You have got a digital interface now, and everything, like you were pointing out about some app which help you in, readily opening up an account and getting a disbursal maybe. All of that falls under digital lending, but primarily there has to be an digital interface, right? For that matter of fact, need not be an app based. It can be a website based as well, or, other digital modes that are available, but it has to have that digital interface with the customer. Now, if you look at in the traditional way of things, actually in India, the credit penetration has been significantly low, and the demand has been huge, right? Either on the non-individual sense for instance, MSMEs and a lot of startups and everything else, or from even an individual sense, that is retail customers who probably don't fall in the formal financial ecosystem, right? And we know a lot of them, right, which are from maybe a lot of people who are out there as migrant workers, and also a lot of younger people who are coming to the financial ecosystem but probably haven't started earning, haven't started finding their ITRs and everything else. So that's where the our credit penetration rates have to be significantly expanded, and everything has to go up. Is the one side of things. And the other thing is this, that for people who are not there in the formal ecosystem, or rather financial inclusion as a measure for that to happen, one has to ensure that credit goes to everyone who deserves or can take that, has the credit appetite. Now, the life cycle of a credit product is basically you source a customer. So a lot of these products are aimed towards sourcing, right? And then you underwrite that particular customer. Underwriting is nothing but your credit risk in a credit risk assessment or risk assessment, because how risky am I? What does my credit score tells you as the lender all about me, right? How much of a risk can you, and inherently credit is a risky thing, and the primary risk is credit risk, right? If you give loan to someone, they might not just pay you back, and that's credit risk. So how do you underwrite that particular customer? Then comes your disbursement, because earlier what used to happen, for you to sign those thousands and hundreds of papers and then get a disbursement after a lot of after a couple of days, or maybe a couple of months. Now it has been significantly reduced, and I'll come to how DLG has also sort of significantly helped on to that. And then is your collection, and then basically reporting, right? So reporting comes in wherein I go on to collect from you, and probably you default or something of that sort. Then I'll have to report to the ecosystem that, hey, here is a defaulter. The other lenders be rather cautioned, right? Because of two reasons. A, I am not getting my money back. I don't want you guys to get your money back. Probably that's a regulatory intent. The other intent is this, that if he takes on another loan, then he is already going to probably be in much more of a financial difficulty to pay mine back. So yes, so these are like, this is like the broader overview of what I can say is like the credit life cycle, the digital credit life cycle of a product. And how does the process takes place? You probably go onto an app, you fill out certain details, submit your photo, KYC, get your KYC done, like you were saying, and in a snap of seconds, the credit decision is made. You're given a limit, or you're given a particular amount that you can take out as a disbursement, and then basis your needs, you take the amount that you require, and then you repay it back. So now this product can probably be structured in multiple ways, right? So one way to look at it is who's going to lend, right? Who's going to be the lender? So a classic vanilla lender can be, say like a Tata Capital, or any NBFC for that matter of fact, right? And then you have also got other models wherein there are smaller NBFCs which get money from bigger NBFCs. That is called as an onward lending, and they lend it to retail customers, or non-individual customers, corporate customers, if I can say so. Or it can so happen that two banks come together, or one bank and an NBFC, or two NBFCs come together on a co-lending format, and they lend together, right? So I'm just trying to throw some product routes that exist, right? And then either there can be also a loan sourcing agent. So a lot of modern day fintechs are very good at data analysis, right? So they know that in a particular city, what segment or its zone probably consists of those segment of people who are good at credit consumption, and probably good at repaying it back, right? Or probably they know that geographically, territorially, age-wise, everything, which are those segment of people to whom you can approach. But they don't want to probably get into the whole credit risk assessment aspect, right? So they would give all of that data to, say, the lenders that typically exist, and they would then use it to go, or rather fulfill the aim of credit penetration, get their products more sold to a wider range of more out of the whole total addressable market, more relevant market, if I can say, right? So that's where the whole role comes in. Now that's called as a loan sourcing. So loan sourcing can be done through a loan sourcing agent, and the decision lies on you as an underwriter, that whether you want to give the loan to that person or not. So I might refer you 100 clients. You might decide to just give it to 2, or maybe 20 or 80, whatever's your underwriting, and everyone's underwriting has to be different, right? It is different because it's a commercial call, and rather it's not that much regulatorily driven, if I can say so. RBI has given you the free hand as to how do you want to, probably. But of course, being in the ambit of things like you cannot give it to a willful defaulter or something. That is needless to say. And then comes the aspect of loan collection, correct? So you might employ certain agents who would go out and collect certain loans, right? So we saw during the pandemic that there were like a lot of so-called Chinese apps and everything else which resorted to a lot of unethical lending practices, sort of ruined the ecosystem a little bit. And then RBI comes in and puts up these digital lending guidelines, right? Now, the aim of the digital lending guidelines is to create a parity between different lenders. So, for instance, today, just because lending has become so easily accessible, I can probably go and quickly look 10 apps. And how do I decide that which app is the one or which lender is the one from whom should I avail the loan, right? Now, in a typical transaction, what happens? You get something called a term sheet, right? So if I were to ask some 50 investors to invest in my company, I would say get 10 term sheets, maybe because all 50 won't agree. And out of those 10 term sheets, whichever suits my requirement the best, I will probably go ahead and take that financing option, right? In a similar way, what happens that RBI has now said that everyone's supposed to give you a KFS, a key fact statement, which is nothing like a sanction letter or something of that sort. And that's very, very, very easily read. It's like a 1-pager or 2-pager document. And on the apps that you have these 5 cost of credit that you need to compare, right? So if you're availing 10,000 rupees, someone's charging you 10%, someone's charging you maybe 16%, someone's 18%. How long is the tenure? How can the EMI be distributed? How much is the EMI amount? Now you suddenly have a lot of more data from a customer's perspective, and therefore it's easier for you to take that, right? The other thing was this, that a lot of entities were lending in the prior pre-DLG segment without having a lending license. Now, why is it important to have a lending license? And this is where we as lawyers must understand the regulatory intent of things, right? So the RBI gives lending licenses to, say, NBFCs or banks, for that matter of fact, right? So they have like a lot of capital and capital adequacy requirements, a lot of enhanced KYC, and a lot of regulations being followed and everything. And super so-called a lot watertight as compared to other unregulated players, right? And then you probably seek out your lending license. But if I were not to do all of that, what will happen is this, that I will probably go ahead and ask maybe Naman and Nikhil, who are two very good investors, some 300, 400 odd million dollars, right? And as like an equity investment in my company, and just go on to disburse that to so-called my data analysis on the belief that these people will, give me back my money. And suddenly it turns out that just because I don't have all of these regulations being followed, my systems are not in tight or not in place, and a lot of these people default. So who's going to be the ultimate, loss bearer for that? Not just you guys, but you guys would probably, in any formal ecosystem, you would have taken the money from someone else and then from them. So some set of customers are always going to get badly impacted in that way. The other pressure which I'll feel probably is this, that, hey, why are you not returning my money back? And then I would, in turn, as a vicious cycle, go on to probably harass my customers in different ways or do something which is unethical, illegal. And that is something which has also been curtailed by the digital lending regulations. The other important aspect is the fund flow. If that's precisely being something that has been targeted by these guidelines. They say that the fund flow must always happen to someone from who's something called as a regulated entity, who holds a license to, give loans, to that of the end customer. So that tomorrow, if I don't have a license and I'm one of these type of private entities which just got incorporated and I'm so-called a very good startup or whatever, and I just want to end up delivering money, that's not going to happen because I don't have the license to do that. Otherwise, the whole point of having a license goes redundant. So that is something that has come in right now. And so has come in that what would I then do in the whole system, right? Now, the other aspect is this, that I was pointing out earlier, that typical traditional lenders don't have like a lot of information, or maybe don't have that digital interface to connect with the relevant set of people, right? I can probably provide them with those. And that's where my role as an LSP comes in. So there are two very important constructs under digital lending guidelines. One is called as a lending service provider, and the other one is called as a regulated entity. So LSP is nothing but an agent of the RE, which can do certain tasks, either help you in doing a so loan sourcing, or providing that digital interface, or maybe helping you out in collections, all of that. Now, also important is to remember that there is something called as the outsourcing guidelines, right? And they tell you that as a lender, what are some of the core functions that you cannot outsource? And if I were to ask you, I'm pretty sure you guys would say, basis what we've been discussing earlier, that you cannot outsource the underwriting aspect itself, because that's where you're getting your license for, right? You're getting your license so that you can do a risk assessment on the customers. You have been licensed, the system trusts you with that fact. So therefore, that's something which is very, very, you cannot outsource it for that matter of fact. But you can get maybe some assistance, right? Some more data engines, some more algorithms and everything else. But you'll have to do it under your own rubber stamp, correct? So those are, that's how the regulations sort of interplay. And I should not be the one, just because I'm giving all of these services to maybe a customer through an app. I should not be the one to charge that customer. Because I am ultimately whose agent? The RE's agent. So the RE is supposed to pay me the commission, right? So now I am incentivized to ensure that my customers don't get due, but the RE gets assisted in a real-time way. Because if the RE fails, I don't get my commissions, right? So you can see how the whole, a lot of these loopholes which exist pre-DLG era, the regulator comes and tries to fix those loopholes through all of these different mechanisms, right? So that's pretty much the intent behind DLG and the spirit of DLG. And I think the other aspect of your question would be is that how do you ensure that in a pre-DLG format to that of a post-DLG format, what has happened, and how would have people sort of moved into? So yes, like with any oncoming set of regulations, you would feel that a lot of technological changes or system-wide changes would have to be incorporated. All of those things were required to do. A lot of unethical players did get weeded out, because now you cannot have any other fund flow apart from this fund flow. So you, just because you hold some odd 500 crores, it does not mean that you can suddenly go out and start distributing money as a money lender, right? So that's something that has happened in the post DLG era. A lot of system-wide system-wide integrations and a lot of system-wide changes have to be done now. KFS, for that instance, right, has to be something that has to be displayed on your screen just before you avail the loan, right? So that you have got now 10 apps, you have 10 KFSs or 10 term sheets, and you know which one is the cheapest loan, which one is the loan which you actually require and suits your requirements the most, right? Suddenly you can tick mark items and take things which you need, which you actually need. A lot of push products cannot be compulsorily sold now. So for instance, a lot of people used to sell insurances through unethical means, as if you don't take it, then we won't give you the loan. Those days are now gone to a great extent, if I can say so. So yes, that's been a very healthy change. The other thing which has happened is this, that traditional lenders now have a partner in the ecosystem in the name of LSPs, right? And LSPs have for their bread and butter the task of assisting the REs to ensuring that they give a better set of customers or better set of lending services to the regulated entities. I hope I have answered your question to some extent.
But I think, I think essentially that, sir, that the entire concept of having a regulated entity and the relationship of the FinTech is essentially, in such a situation, the FinTech is the lending service provider.
That's
and
correct.
Essentially it's like the bank needs the FinTech as much as the FinTech needs the bank. So it's a symbiotic relationship there. The bank obviously wants to reach out to more customers and sort of have even outsource their loan sourcing activities to most companies. So for example, if there's say one FinTech which is doing the loan sourcing, which is helping with a bank, say federal bank for loan sourcing. So essentially, the underwriting formula that this fintech sort of employs and their credit risk-based assessment is also something that the fintech is taking care of. So it's like the fintech is giving good customers and credit-worthy customers to the bank.
So
And the
Nikhil, I
banks
would like to correct you there.
right,
That's precisely what a fintech cannot take care of. That's what I'm
right,
saying. Fintech will have to, because those are not outsourceable functions. And
correct,
we as lawyers will have to look at the outsourcing guidelines to understand what can be outsourced. A credit risk assessment cannot be outsourced. So
okay,
yes, what the bank can potentially do is maybe use those algorithms in its own, in-house unit, right?
okay.
To do the credit risk
Right.
assessment,
So,
because the bank has the
okay, I
license.
think I must have misspoke. My point was that essentially the credit risk assessment is no longer in an offline format like how it used to happen before. They use
That's
these
it.
algorithms and technology to fast track that
Yes.
credit risk assessment process, thereby giving them access to better credit worthy customers itself, which is
Correct.
a win-win situation for both the fintech as well as the bank, in my opinion.
That's correct.
So,
That's correct.
right.
And
Thank
just
you
to
for
add to that,
yeah.
collection, even your digital app processing, KYC, a lot of these things, right? KYC assessment. Again, KYC is not outsourceable, but having the help of an app to take your picture, to take your relevant different data points so that the KYC can be done. See, the
Right.
ultimate KYC that, yes, Nikhil is the one whose photo is there versus Nikhil's Aadhaar card. That decision always lies with the RE. But for all of those data segments to come away and that LHS equals to RHS to happen, how easier can you make that whole process? That's the LSP's job now, if I can say.
Right. Yeah, I think thank you, sir. For now, I think we'll move on to another part of the fintech market itself. And this has been something that has been in the news recently because of the RBI coming out with detailed guidelines and allowing it finally. I think I'm talking about the first loss default guarantee guidelines at this point, where essentially the digital lending guidelines, just to give everyone and all the viewers a little bit of context, the first loss default guarantee models are something that was, in fact, not allowed under the digital lending guidelines of September 2022, when, in fact, paragraph 15 of those guidelines, in fact, mandated companies to adhere with the securitization norms under RBI's framework and basically categorizing the FLDG model as a synthetic security, which was something that the players were not, the fintech players who were dealing with FLDG models, who were essentially say players like Slice, where they were offering FLDG models. It sort of hit their entire core business idea itself, and it was like that entire segment or that entire business itself was outlawed by the digital lending guidelines of September 2022. And most of the companies that were dealing with this FLDG business model had to pivot and had to sort of figure their way out of that regulatory issue. But now recently in July, just a month back, what has happened is the RBI has come up with detailed guidelines allowing FLDGs, placing a cap of 10%, 5%, if I'm correct,
5%,
5% on each FLDG lender, as to 5% of the entire loan portfolio can be guaranteed by an FLDG player. And I think this is, again, to just deconstruct this topic and just to understand more on this. Amit sir, if you can just tell us what exactly the FLDG is, how it works, and what exactly is the first loss default guarantee model?
Great. So FLDG continues to be one of the elephant in the room, right? So in most digital lending discussions and, and also in the larger policy wide gamut, if I can say so. Now, what precisely is FLDG? It's better to understand what is a guarantee, right? So guarantees have existed for long back. Again, as long as probably lending has existed, guarantee has existed, because not everyone's going to trust you that you're going to repay it back. So there's going to be a guarantor who's going to come in and he's going to say, if he fails, I'm the one. You need to catch my collar for that. Now, what an FLDG is, primarily, it's a credit risk sharing arrangement, right? It's more, I would say it's probably more of a akin of an indemnity than a guarantee. But again, let's not go into the whole jurisprudential logic behind it. But primarily, it's a credit risk sharing agreement, wherein in which a third party comes in and they agree that they will compensate for a certain amount of the loan portfolio's default if that were to happen. So for instance, if I were to give a loan pool of 1,000 crores, and if I get a first loss default guarantee for 100 crores, so say if there are 10 loans that I've given for 100 crores each, and out of which the defaults start happening, then the first 100 crores in an overall pool-wide basis is something that I am trying to guarantee to you, right? That's the technical definition of FLDG. So you are going to do a first loss default guarantee, guaranteeing 100 crores out of a pool of 1,000 crores of loan which has been given, right? So in a similar way, there can be a second loss default guarantee, third loss, and these are typical. And the concept, by the way, comes from typical financial transactions being structured, right? So banking and finance transactions, you would probably see a lot of these transactions that sort of exist. These have FLDGs, and securitizations transactions have FLDGs, for that matter of fact. Now, the problem with FLDGs was this, right? So imagine in a scenario wherein you are pre-DLG, correct? So no laws exist and nothing exists. Now, if I were to start giving a good hefty FLDG to someone such as a lender, there's a huge chance that lender will become a little bit, probably get over the line in doing a credit risk assessment, because it knows that, hey, if a default happens, there's someone who's going to come and guarantee that, right? So I'm going to be rather not taking my job maybe that seriously of underwriting customers. And that's where that whole attitude approach in a lender comes in. If the FLDGs are given in a not so well thought out manner, right? And suddenly the spillover effects of not having a license but still doing lending suddenly transfers to a regulated entity, maybe. Why? Because they are getting guarantee supports of huge amounts from someone who probably holds nothing whatsoever. So this was sort of also ruining the system to a great extent, apart from many other reasons that sort of existed. So now the RBI came in through DLG 1. So DLG 1.0, RBI says, hey, no FLDG allowed, and that suddenly does two things. Now, since FLDGs are not there, if I were to, like Nikhil and I were discussing, that if I were to use certain logics from an LSP, which is say Nikhil, while I am being the regulated entity, what is the incentive for Nikhil to be always correct? Right? I should have some amount of control over Nikhil. If he is giving me certain logic to credit underwrite a customer, or if he is giving me sourced out customers, if all 100 of them turn out to be bad, and Nikhil says, hey, I'm anyways going to get my commission, the max, I will not get my commission. So what is Nikhil's incentive for that? Now RBI has realized that. So RBI says that, okay, Nikhil can probably give 5% of FLDG in those scenarios, right? So just because Nikhil is now out of 100 rupees, 5 rupees is something that Nikhil is going to contribute. Nikhil has this incentive, or rather that whole stick approach, wherein, he will have to do his job more seriously. And that will, in a way, in turn, make the whole system better. So that's the whole concept of FLDGs. And ultimately, we must not forget that it's a credit risk sharing arrangement.
Right, sir. I think moving on to the next set of questions we've had with this. I think another service, sir, that is growing very efficiently in the market is the buy now pay later service. I think, with example, so I remember when I used to order something, say if I order a pair of jeans on Myntra or say Amazon, there's this one option called Lazy Pay. And back during COVID, this was really big. It was a very attractive thing to use. I think I personally have not used this Lazy Pay feature, but I know friends of mine who have, and they've splurged and they really bought a lot. They've done a lot of online shopping by using this buy now pay later models on Amazon by like Lazy Pay. So I think from my understanding, what I know is, and I think the major problem that came up is something you can address in the answer to this as well, is that essentially what these buy now pay later models used to do was that they used to take loans in your name without essentially informing you, which was the major problem with RBI from a regulatory standpoint. Is ki, boss, you can't take a loan in my name without the proper KYC and the proper structure and the proper process being followed. So I think with that context, sir, can you elaborate on a bit more on what exactly the buy now pay later model is? And how exactly does it work?
Right. So let me start by giving you a product perspective, right? And that's very important for any fintech lawyer. I am to say, you cannot leave your product behind and start discussing something in isolation. So BNPL, sort of the USP for that product, or the unique selling proposition that exists, is enhanced user experience. Like you're pointing out, you can quickly get onboarded You can quickly get a loan for a small ticket loan for maybe a headphone, the new Sonys or the new Bosses or whatever, and quickly get that whole transaction done so that it's delivered to your doorstep. While you probably might not have that much of money at that particular period of time or in that particular month of time till your salary is awaited to probably buy that. So you do a BNPL. Now the BNPL model, of course, while being easy payments and fast onboarding and greater user experience, was also sort of maligned by a couple of things that you were pointing out, right? Wherein someone who does not have license starts giving you a loan. B, a lot of companies, what they started doing is they started using something called a prepaid payment instrument, right? A semi-closed prepaid payment instrument, which is nothing but your wallet, right? So for instance, now we all know that wallet opening was quite an easy procedure, at least till the KYC norms got amended. So for a large period of time, you just install Paytm on your phone and you're good to go, right? Or you install a new wallet product on your phone and you are good to go. Now imagine that, say a wallet from a company XYZ, right? And you quickly open that wallet, and that wallet was now being filled in with credit from their side. The actual intent of a wallet is not that. The actual intent of a wallet is this, that you load your own money and you use it basis your convenience. But suddenly I'm using that to get money from regulated entities, right? And this bypasses the whole credit card system, right? The whole credit card ecosystem is based on the fact that you will do certain credit risk enhancements, assessments, and all of that for someone and probably offer them a credit card, right? So now you guys will graduate out of law school, join some good fancy law firms in houses, and then you'll start getting your salaries, and the banks would know, oh, so this guy makes probably this much, so this much is the amount of credit card that I can issue to him, right? So why? Because of the fact that they know all of the data which is coming in your savings account is something that they can see, they can underwrite you, they know how much expenses are you incurring, and basis all of that. Now, how many people do you think have actual formal bank accounts? For a credit card to exist, you must have a bank account. You must have a incoming payment on a regular basis or on some, some blocks of time so that they can be, those data points can be used for credit risk assessment. Then you will have to ensure that that person particularly pays the bill on time. That's another important aspect, right? So all of these regulated functionalities that has to be done will basically, the whole system now is suddenly being said that, oh, there's a wallet, I'll fill it up. If you want to take some loans, you take it from there. If not, I'm going to charge you some hefty fine and penalties. So suddenly you are doing unregulated job, right? And you're also killing an industry which already exists by following a very tightly knit regulatory framework, correct? So that was the precise problem with RBI. And RBI said that, hey, this loophole needs to be plugged in. So last year, somewhere mid-year, they plugged that loophole in. And a lot of entities that, all of us know, they sort of got wrapped up in this whole procedure. And a lot had to change their business model. Now, it's important that what can you do, right? Like, so as a fintech lawyer, a lot of these clients will come to you and they'll be like, hey, new guidelines came in and my business got disrupted heavily. How do I go back to the market and disrupt it again, right? So then you probably go back to the basics and do that mechanism in your head. And that's what DLG is primarily, right? You think that, okay, I can get in the money from a regulated entity and I can use it for disbursement. So imagine in a pre-DLG format, but these entities have now been wiped out their business. So there are two guidelines, right? So one comes in August, the one has probably landed in April or May. So in between that, you have to advise your clients because you don't know the one which is going to come in August or September or when. So till that point when it has come out, you're going to tell your clients that, why don't you approach banks? Why don't you approach regulated entities which can actually give loan, who have the license to give loans, and connect them to the relevant set of customers? That's precisely what DLG captures also, right? As we were discussing. And that's where the whole BNPL model got shifted now to two different types of product. One is called as a transaction credit model. So what a transaction credit model means is this, that every transaction, it will be treated as a credit. Okay? The other thing is called as a deferred credit model. What a deferred credit model is this, that you buy a good from Flipkart, say like a headphone that you really love, and maybe after 60 days, you make the payment. And in the 60 days, you can give it one third, one third, one third. But after 60 days is something that I'll charge you certain amount of interest. Now, we both know that for the first 60 days, if you are not to levy certain interest, that's a more risky proposition any given day as compared to something which is on a transaction credit, that is the interest starts accumulating from day zero, right? So these are like typical commercial models that exist in a legal sense of the way now, and how you can do it probably. And all of them can be categorized as buy now, pay later, right? Because you are buying now and paying it later when you probably have your salary hitting your bank account, or when you have, in case of a lot of Gen Zs and everyone else, the parents pumping in money in the next month, right? So everything else. So that's the whole BNPL segment, if I could summarize for the audience. Yeah.
Yes, sir. Thank you so much. I think with that product and sort of understanding how it works, I think now we can jump into the legalities of it. So, sir, how exactly have BNPL players evolved over the years in terms of the regulatory aspect of it? How have regulatory challenges, in fact, shaped their business models? And maybe we can also discuss in this part specific BNPL models like you were giving examples of. So, for example, a Flipkart or a Lazy Pay, or say, for example, even an Amazon Pay for that instance. So, how exactly has the regulatory landscape been for BNPL players till now?
Right. So a lot of these BNPL players, what they would do is they would align themselves to a regulated entity who has the license to lend. Because in a BNPL, you must always remember there's something being lent, right? Or there can be a different model wherein, say, someone does an invoice financing for you, right? So if I'm say like a Flipkart or an Amazon or some e-commerce giant, what I can say is this, that I know that you've been doing hundreds of deliveries per month from me. You've been taking that, you've been placing fulfilled orders, paid orders, and everything else. So probably on the next order, what I'll do is this, that I'll ask you, or I'll give you that 60-day of time frame, because I can see that most of your headphones or most of your audio segment products were maybe in the range of 2,000 to 5,000. Now you suddenly want those new Sony noise cancellation gear, right, which is costing around somewhere 27, 30,000. So I'll probably allow you to do that, provided you pay me in 60 or 90 days, right? So I'll do nothing, but I'll finance your invoice in a way, right, and wait for the money to come in. That's one way that you can go about it. Or the other way can be this, that I align myself with a lender, right? Or I find a relevant LSP, correct? Like a Lazy Pay or like a Pay with Ring or something of that sort. And these people at the back end have multiple lenders who are ready to pump in credit, correct? So I simply go to the checkout page. The checkout page will be probably that of Razorpay or a Cashfree or the work. And there I'll see the pay later option. There I'll get multiple options. There will be one called as a Lazy Pay, one called as a Pay with Ring, one called as Simple, and all of that. And I can choose whatever product I like. The product will have to follow, by the way, all of those same standards. It will quickly open a new page, or a new, if you're an app, that particular app. If you're not onboarded on that app, it'll ask you to onboard. So you have to get your KYC done. So your KYC is done. After that, it'll show you a KFS, correct? A KFS is something that will help you out to, that new 30,000 headphone, which one is the most cheapest bank, which is going to be there for you, right? So that's something that you are going to avail, and then you are going to do that. Or otherwise, if Flipkart or an Amazon were to offer you the typical BNPL of deferred credit model, that is for 60 days or 90 days, whatever. And then after that, some fines or whatever, right? In the form of basically interest coming in. So since for this 90-day period, commercially speaking, you didn't charge interest, the interest rates are going to be typically more higher, right? Because there was no interest at all. So I'm going to make money from only those customers primarily who are going to default, right? Versus a transaction credit model wherein every customer was being charged interest from day zero. So probably my interest rates can differ, but again, that's all a commercial thing. You'll have to go set out and compare, and that's what RBI wants you to do, right? With the easing up of your KFSs, information flows, and everything else, that's something that will become easier for you. And that's how the whole legal come product fit happens, and you get a lot of these BNPL products out there.
Right, so thank you. I think now that we've covered buy now, pay later models, we can move on to the next point that we were going to discuss. In fact, now,
Also,
in
Nikhil,
fact,
just to add,
yeah,
since you were asking what are the different BNPL mechanisms. So one is, of course, a savings bank account being, sort of linked with an NBFC line of credit. That's also an option that can exist. There can be, the PPI loading mechanism cannot exist, by the way, with a credit line that we discussed because of the previous year's guidelines. There can also be savings accounts, you know, being opened up, which can be filled in with credit. So today, what has to be done is this, that DLG says that the fund flow has to go from NBFC's account to the customer's account. So the customer's account has to be created, right? For many first-time customers, that might just be the first savings account that you can create. So you can have like a product leverage of creating a first savings account by a bank and then filling it up with a NBFC money or like with a regulated entities money into that. So yeah, these are like different models that exist on the BNPL.
right. So thank you for that. I think now we can move on to the next part of our discussion, which I think we'll be talking about payment systems. And I think so, since now you have joined recently Cashfree Payments, which is a leader in the payments ecosystem, maybe you could throw some light on what exactly these payment systems are. And I think we can discuss four main topics under that. What exactly is a payment system? The regulatory aspects of how exactly these payment systems are structured and regulated, in fact, and how exactly does a payment, in fact, take place on such a payment system? Please, sir.
Correct. So payment systems is, again, if you were to look at the regulatory history behind it, it comes from the PSS Act, of Payment and Settlement System Act, as way back as 2007, I believe. And the whole intent behind that act is to ensure that settlements take place. So the payments, now we have moved from one segment called so-called digital lending to that of the payments ecosystem. The payments ecosystem is all about taking money from one player and giving it to the other player, right? So that one player can either be one regulated entity, one unregulated entity, whatever. The other player can be a customer, a merchant, or whatever, right? So it can either be me paying money to Nikhil, both of us can be just individuals, or me paying money to Naman, who probably is an e-commerce player, right? So in that case, Naman will become a merchant. And similarly, Naman paying something to Nikhil because Nikhil is supplying him, say, shares, maybe, right? So the both of them are merchants. So there can be multiple things, right? So the whole ecosystem sort of been designed that money settlements happen over time, right? So it's very important for us to understand who's going to be the payer, who's going to be payee, who is the intended, what is going to be the settlement rate, right? Because there's so many settlements which are going to happen. How do you increase the settlement cycle and the ease of settlement? That has been the policymakers' domain, right? In this whole ecosystem, how fast can the payments take place? And that's where UPI is the king, right? We all know that UPI payments are so fast, and a lot of rather other jurisdictions have sort of also eyed upon our system, and they've got into a lot of these MOUs have been signed when the government is coming and trying to help them up build their own UPI systems and whatnot. But the major thing is this, that who's going to be payer, who's going to be beneficiary, what is going to be clearing payment settlement service, and all of that, right? So if you look at the traditional definition of payment system, right, in the PSS Act, it simply says these particular elements. It says that there's going to be a payer, there's going to be a beneficiary, there's going to be a payment system, which is going to enable them so that a clearing payment and settlement system happens between them, but it will not include a stock exchange, correct? So in a typical way of things, now let's try to understand as to where did these payment aggregators, so-called, came up into the scenario, right? So before payment aggregators, there used to be NEFT, RTGS, typical money order transfers and all of that existed, right? These took certain amount of period of time because the servers had to do the reconciliations at the back end. Right now, what is reconciliation? Reconciliation is a very important thing. You always reconcile two accounts, right? So for instance, if I am the one who's going to pay to Nikhil, then Nikhil's account should show a credit of that amount. My account should show a debit of that amount. And both of these accounts should be reconciled with that same amount. Correct? and also the internal factor that I got that instruction from someone else so that that payment be made, because probably I'm a bank, right? So and Naman holds an account with me. So Naman gave a net banking instruction that, hey, there's 5,000 rupees that you need to transfer to Nikhil, right? So how's that going to happen? Now, what will happen is this, that while Naman gives that instruction, I will have to make a audit log, or a log of, or a book of accounts of a way wherein it should say that this much amount of money is something that have been instructed to the bank to pay to Nikhil. And Nikhil's bank should have that whole particular system wherein it should show that the bank from which it came was Amit's bank, and the account holder was Naman. So all of that recon process has to be extremely watertight, right? Because if you mess out anywhere, you will not be able to probably always backtrace that transaction, and there'll be no legal basis in a monetary system so that transactions can be, matched with each other. And that mismatching can have severe economic flaws. So the payment aggregator ecosystem, or the PA ecosystem, which you right now here and what a Cashfree or a Razorpay is, they basically happen to hold a escrow account, right? So in an escrow account, what happens, imagine to be like a account, an all-purpose account, a big account of sorts, wherein thousands of players are putting in money and thousands of disbursals are also happening, right? And the tech behind it is something which these PAs have now come up with, right? Which allows more faster transactions to take place as compared to the traditional banking setup, which already existed in the form of NEFT or RTGS, right? Now, this is backed by something called as an IMPS, or an immediate payment system. I'm pretty sure you guys would have heard about that. So the whole, since the question was centered around me joining Cashfree and the payment aggregator ecosystem, that's how it works. There's another aspect to it, which is basically the Bharat Bill payment system, which is also a different system which has been floated by NPCI, wherein you can have multiple billers. So for instance, I have Bescom, as in Bangalore, the Discom which serves me electricity. You are based out of Bombay, it might be Adani, right? And you have your Airtel as your broadband, and your postpaid services as Geo or something of that sort. There are multiple bills which need to be paid, correct? Now, these bills, what will happen is this, that you can go and add it to multiple different billers. You link your bills so that the amount gets debited each time a bill comes in, and you don't even have to care about it. Two things happen. A, most of these bills which are required to be paid, the other side, the entity which is going to receive the bill, will be now more secure, right? Because it knows the on-time payment thing will keep on happening till the time that you have a savings account. It's not just on my memory, right? It's on the system's memory. So that's another leg of the whole NPCI thing. There's another thing about UPIs. We all know how UPIs are based on. It's based on IMPS, and you've got a VPA ID, and you've got something called as a third-party application provider, TPAPs, which are your Google Pays and all of that. And that's the whole ecosystem that it works. So without getting too much into the regulatory side of things, let me just tell you this, that payments are all about settlements, quicker clearing, and quicker e-commerce transactions to take place, right? Not just e-commerce, but any transactions, financial transactions to take place, right? So that's pretty much the whole objective of a good payment ecosystem.
Right. Thank you, sir. I think with that, I think one thing that really resonated with me was that when you talked about how the data points have to be used by these payment systems, and how watertight that system has to be for the entire ecosystem to work in the first place. I think that is something that we'll be talking about, where I'll pass over the floor to Naman, and we'll move on to the third part where we'll get into the topic of KYC and data analytics and all that. But before that, I think just for the benefit of the user, benefit of the viewers and everyone, so that we're all on the same page, I'd just like to just quickly recap what we've covered till now, because I think sir has spoken quite a bit on varied concepts within the fintech market. And I think at this time, if we can just have a quick recap, it'll be great. So I think first, sir spoke about digital lending itself and what exactly digital lending is, the guidelines regulating digital lending, which is the RBI guidelines on digital lending, which came out in September 2022. The major point of discussion around these topics was how there is a two-part structure in the digital lending guidelines, where banks are essentially known as the regulated entities or the REs, and the lending service providers, LSPs, are essentially what the fintech companies are. And the symbiotic relationship between the RE and the LSP is where the fintech market thrives and sort of survives. And that's as far as digital lending is concerned. Now, after that, we focused on our discussion around the concept of first loss default guarantee, the FLDG framework, which has now been allowed by the RBI in July 2023. And we also discussed how these models work and what the current position in terms of in terms of a product mindset for these models are concerned. Now, after talking about FLDG, we moved on to our discussion about the buy now, pay later service models and how companies like LazyPay and how the product itself is structured and the legalities around it. So how the BNPL's regulatory history has been and how the challenges are being addressed currently by fintech players. I think that's something we had a discussion on. And finally, we was just talking about the payments systems platform, where essentially, if I were to just simplify it for the audience, payment systems is the biggest and the greatest example for payment systems is the UPI framework. Any Google Pay, any Phone Pay, any Paytm payment that you make, it is a payment system that is allowing or is facilitating this transaction that you are conducting over Google Pay or Phone Pay. And there's a lot of data involved here. And now, as Sir was mentioning, it has to be a watertight system for the financial data to, in fact, flow from one player to the other, from point A to point B. So if a person A is sending money from his account to person B, this transaction not only has to be recorded on the payment interface server, it also has to be updated in the bank server as well, because essentially the ultimate transaction is happening between the two bank accounts of A and B. So for the purposes of the bank itself, the updating of that data and making sure that this financial data doesn't leak for the privacy of the customer itself is something that is very important. So maybe we can now move on to the third part of our discussion, where I think I'll pass over the floor to Naman. But thank you for that.
Pleasure.
Thank you, Nikhil, for summarizing all of the things very well. Continuing further the discussion, sir, you mentioned regarding the regulatory compliances for fintechs with respect to KYC. So can you elaborate a bit on what are these compliances and how fintechs are handling these compliances?
Okay. So see, KYC in a way, and a lot of people think that KYCs are boring and like rather something that creates an impediment to business. But believe me, KYCs are the most important system across maybe most jurisdictions which have got a solid financial or a monetary system in place, right? Most jurisdictions that are there. And KYCs are aimed at two things. A, to know that who's the person who's going to do that financial transaction, vis-a-vis which person he's going to do the financial transaction, and the fund flow that that person makes, right? Can it be tracked or not? And therefore, ensuring at the same point of time that any AML concerns, right, or anti-money laundering or other money laundering concerns and anything else can also be curtailed in the whole process, right? Now, in respect of fintechs doing KYCs and how are those compliances handled, there's something called as a KYC master direction, which has been sort of released by RBI way back, and it keeps on getting updated every time RBI makes certain changes to it, and the whole design behind it, and let's look at the last amendment which came in there, right? Now suddenly it says that there are multiple ways of doing KYC. So there's something called as a full KYC, there's something called a minimum KYC. Depending on if it's a small wallet that you are creating, you can probably live with a KYC which is not as stringent as a full KYC. And there are multiple different ways of doing KYCs. For instance, you can fetch. So how a KYC process works is this, that you can look at one of the schedules to understand this, that in KYC, you take the data of the customer at one hand, and you take the customer's own personally fed data on the other hand, right? And you try to compare both of these and find out that whether these are matching or not. So I'll be asked that, hey, Amit, what's your name? So my name is this, this thing is this, and then also provide your Aadhaar card. And now Aadhaar card, it will have to be triangulated with the Aadhaar ecosystem, which is already there, right? So my Aadhaar matches with the system's Aadhaar, and the name which I've provided matches with that, right? And therefore my address and everything else. So that's how typical KYC process is supposed to happen. Now that requires you to have something called as an authorized officer. So you need to employ those people. They are going to do this LHS RHS thing every time a new customer comes in. Now, you and I both know that if you've got millions of customers getting onboarded probably in a year, that's hardly possible that you will have these many KYC agents, unlike a bank, right? At least for fintechs. So in a bank, what would happen is this, that you go to open an account, they'll ask you for all of these documents like your Aadhaar card, PAN card, and all that. They will do all of this and then do it and then open your account. Whereas for a fintech, it's quite impossible for you to even incur that cost, right? Because that will increase your what? Your something called as a CAC, a customer acquisition cost, correct? So your KYC has to always, commercially speaking, be feasible with the CAC that you are trying to have, because your CAC is your overall cost of the product. It's something which CAC forms a part of, right? The customer acquisition cost. Now, what you need to do is this, that you need to find out which KYC mechanism is going to be the most commercially feasible for you to, while ensuring lower CACs. It also serves the purpose in essence and spirit that you have done a KYC and you have the record of that particular customer, right? So a couple of models exist. There's something called a DigiLocker mechanism. So DigiLockers, we all know, we all have DigiLockers, whosoever has an Aadhaar card. So in the DigiLocker, you already have your license, your Aadhaar card and everything else. So you can triangulate that data using that. You have something called as a CKYC mechanism, right? So CKYC is a central KYC repository which has been created by the government, which every RE has a duty to update every time they find some newer data into that. So for instance, you got your Aadhaar updated and then you went on to open another bank account. The new bank, which will, what they'll do is they'll fetch your old KYC data from the CKYCR or the repository. They'll see, oh, Naman's address has changed because his new Aadhaar is saying that. So it's their task to update that and quickly send it back to the repository. Now, the other RE to which you go for a loan dispersal, if they are fetching the data from there, they are already having the advantage of having a full-fledged KYC done. I hope you get that, right? So that's another way of doing it. Now, most of these things are not as good or as gold standard as probably actual person sitting and comparing the documents, right? At least that's what the regulator thinks of it. So what they've done is this, that they've said that even if you do all of these things, you'll have to do paperless paperless KYC of some sort, right? And that has to be akin to a face-to-face KYC, right? So a face-to-face KYC is nothing but I switch on my video and I show it to you, you being the authorized officer, that, hey, this is how I look. Isn't this how I look on my Aadhaar card, right? Now you understand that's very expensive, right? Because you'll have to have that person doing what, because he can do only one KYC at one point of time, right? So at the max in 8-hour or 10-hour work duty or whatever that duty time that he has, how many can he do? That's the first thing. You'll have to employ so many people to do that. And the video thing is going to be super costly, right? But if you don't do it, if you don't do a video KYC or if you don't do a normal paper-based KYC, you will have to subject your customers to enhanced monitoring, right? Now, what does enhanced monitoring mean? You'll have to basically potentially look at their transactions more closely, more minutely, because the system thinks that they can befool the whole financial KYC checks that we have there. And unless until their face-to-face KYC is done, they will not be given a complete good go ahead from this. And this is what is the last KYC master direction update that has. Before that, this did not exist. So you had like multiple more ways of doing solid KYC. Got it? So basically, the whole aspect about KYCs and data is this, that you have to figure out your customer acquisition cost from a product perspective. You have to reduce it while also ensuring that you get the good thumbs up from the regulator that you've done your KYC. And KYC is the primary thing during onboarding that one has to check from a regulatory viewpoint.
Definitely, sir. That gives a very good understanding of KYC. Sir, I've been following news for some time, and I have heard that this regulatory authorities have shown their concern over the storing and processing of financial data of customers. So, can you say how fintechs are addressing these concerns?
Correct. So I think how fintechs are addressing those concerns it's much better that we probably focus on how our regulations are at the point of time that we are in. Fortunately, we are getting the bill table this time, the personal data privacy bill, right? So once the data privacy law is enforced, a lot of these concerns are going to get resolved. There's something called as data localization norms, right? So in the digital lending guidelines as well, and IT outsourcing guidelines, that's something there by RBI, which comes in for different players. So there's IT outsourcing guideline for PSO, or payment system operators, right? So all the Cashfrees, Razorpays, and the payment aggregators of the world will have to follow that. There's something called as IT outsourcing guidelines for banks, similarly for NBFCs, right? These tell you how core and how resilient your IT systems have to be to safeguard customer data. Correct. And by the way, as fintech lawyers, that's a tech lawyer aspect that we have over here, right? We have to ensure that all the integrations, all the data handling happens in accordance with multiple of these guidelines in force. So as fintechs, what we are trying to do is this, that we are trying to abide by these regulatory standards and some good industry best practices, right? So a couple of them would be, for a payment ecosystem, it'll be that the merchants are PCI DSS certified. It's a very costly certification, but the moment you do get all of those certifications in place, that means that cardholder data, or a lot of financial data, to that for that matter of fact, will be stored and treated in a certain way because you've been certified, right? So what fintechs are primarily doing, they are getting a lot of these certifications done. They're trying to tick mark as many IT outsourcing guidelines and these type of circulars that exist. They're trying to get that filled. And the major constraint which comes in is in the way of, say, doing a data localization, following data localization norm. Now, a data localization norm will strictly require you to keep all the financial data in one particular jurisdiction, say India for that matter of fact, and you cannot probably send it outside. So if you have LSPs which are sat outside India, right, in a lending scenario, or you have got certain other fintechs which are so good in doing all of this data assessments, which are stationed outside India, all of that will become impossible. Or for that matter of fact, if you have got foreign merchants, correct? Why stick to just India? Nowadays, a lot of your merchandise and a lot of your stuff comes from outside India as well, right? In those cases, how will the data go, right? So that's governed by primarily something called the data localization norms. And you will have to, of course, also follow GDPR if it's a European country, correct? So these are different things which fintechs now have to account for while ensuring that data and other related concerns that you were trying to, you have heard in the news, that's actually addressed by these.
Thank you, sir. This answers the questions very well. We'll now be opening the floor to the audience. But just as a participant myself, after listening to you, I found the field to be quite interesting.
I think, Naman, just before you ask a question, I think first of all, thank you, sir, for answering that question. I think data privacy concerns in today's time and age, with India not having a data privacy law in force, is a very big concern, not just from a market perspective, from a personal perspective, from an individual citizen's right itself to personal privacy. Data privacy is not yet guaranteed. So I think, as you said rightly, I think once the data privacy bill is passed and we have what we can say is, when India does have its data privacy law, fintech companies will then have to sort of rethink their data privacy checklist and their due diligence with respect to that. But yeah, so how this will work is essentially, I think now that we've covered all the topics that we've sought to cover in this episode, I think we'll be opening the floor for questions from the audience. We have 10 minutes left in our session. So 10 minutes is for the audience interaction. Starting with Naman. I think Naman has a question. And whoever has a question, please, you can raise your hands and we can sort of go from there. And please type in your questions in the chat box as well. So, and just raise your hands and we'll be basically asking questions. Therefore, please, Naman, please go ahead.
After listening to you, I found the field to be quite interesting. So, as a beginner, if I want to learn more about it, what are the study sources I can refer to? And when I see it from a career perspective, how in this field I can enter the market?
Okay, so now that's quite a big question. My stance in terms of your second limb of the question as to how you can probably enter the fintech domain as a lawyer is this, that I always suggest anyone that if at all it's possible for them, they must get trained at probably a law firm or somewhere where they get full hands-on with contract drafting or good in-house places, but preferably at law firms, and get to know multiple transactions. So because fintechs is all about it's a lot about structuring of transactions, right? These are nothing but financial transactions that we are structuring, which can be copied by the system on a larger level, right? So you have to structure the first transaction, you have to structure the concept, the product, and the ideation which has happened, you have to vet it. And at a law firm you get to do that for different product segments, A, and B, different types of contracts, right? So, and it's even much better if you start out, say, with a GC or an M&A or Capmark, somewhere from there, and then gradually, sort of shift towards the fintech side of things in the law firm, if that's something that someone can probably figure out for them. Having said that, what can be read or what resources can be referred to? For the tech side of things, there is a very good book by an author. His name is Deepak Singh, if I'm not wrong, right? And he has written a very good book for product managers, basically, which comes very handy for even for us to understand different tech related aspects like APIs and integrations and HTMLs and all of that tech that you basically just need to know, not as like a technology person, but majorly to have that lingo, the correct lingo being used so that you can effectively communicate. That's a very important task of a fintech lawyer, and also to understand the concerns and everything else. The other does Anirudh Kulkarni, I believe he writes very frequently on payments on Medium. So he's got his own blog series running on that for quite some time. It's called Auth Capture. You can probably even refer to that for understanding the payments ecosystem. It's quite handy and it's quite insightful and informative, while keeping it very basic for that matter of fact. The other things that one can look at is frequently search for these LinkedIn resources, wherein bigger law firms keep on coming up with their news articles and blogs and everything else. That gives you a deeper insight and keep a track on the regulatory updates that keep on happening from an RBI's front. Go to their webpage, familiarize yourself with RBI notification circulars, look at different departments, what functions do they do. The other thing that you can do is talk to a lot of these startup or a lot of these fintech people, fintech folks, which can consist not just of lawyers but product managers, tech people, and try to understand, because if you're, for instance, if you're dealing with IT outsourcing guidelines, the best person to probably help you understand that from a system perspective. So your laws will prescribe a lot of things, but whether it's happening on system or not, or what you can possibly or feasibly advise, the best conversation that you can have with is your tech team, right? So you need to know, or rather, if you can interact with those sort of people, they'll be able to make you understand, senior ones in them who know the regulatory sensitivity about things. They'll be able to, sort of give you a very larger perspective. And I think, like Nikhil was pointing out earlier, I don't think so fintech is as a domain per se, a very different domain. It's just a legal domain. So one has to do their own. You must know how a normal financing occurs, right? You must know how a loan transaction happens in terms of documentation, also in terms of having that clarity about what is so most of these B2C segment discussions that we were having are unsecured loans, but most of the B2B segment things will be secured loans, right? So you must know what a hypothecation is, what a mortgage is, right? And you cannot leave your first principles of law. So you will have to always go back down and, probably brush up on to those, or keep on brushing up on those. And there are significant legal developments also happening now since tech is coming in. There are a lot of questions, say, around shared pledges, right? How do those work? Because those are not pledges. Those are basically for intangibles, right? So, and a lot has changed. NSDL rules are there, depository regulations are there, and everything else. So one has to be abreast on all of those changes. So that's, I think, a good probably approach that one can take for entering this market while keeping abreast of different laws and the market developments.
Thank you, sir. Thank you for answering that question. And I think Justice Sir was mentioning that you guys need to sort of keep updated with what's happening in the fintech space and in general in what's happening in law and technology. Not to beat my own horn, but maybe you guys can also refer the LexTech's monthly newsletter, because we cover these updates on a regular basis as to what's happening in the market. So not to beat my own horn, but yeah, moving on. We have a question from Yashunandani, sir. She says, under the new FLDG guidelines, if there is now a 5% limitation on a loan portfolio, will it be on a revolving credit line as well? That's the first part of her question. And the second part is also, will the FLDG be calculated in a particular portfolio after every subsequent loan that is undertaken by that particular client? The question is in the chat box as well for you.
Correct, I can see that. So, Yashunandini, a lot of things we need to sort of understand in line of your question. What do you mean by a loan portfolio, right? The way the question has been sort of asked, I think a loan portfolio needs to be understood in a way that imagine it to be. So there's something called as a pool of loans. There's something called as a portfolio, right? Loan portfolio of a customer. These two are very different things, right? So what FLDG is trying to target is the pool of loans for which the FLDG is being given. So for instance, if I, as an LSP, take 500 CR of, on a 500 CR loan, I give a 5% of FLDG. What it means is this, that the first losses which are going to happen due to defaults and on that 500 CR which has been disbursed, I'm going to cover it to the extent of 5%. It does not matter whether it's revolving, not revolving, or whatever. See, a revolving line of credit can also get defaulted, right? Basically, a revolving line of credit is what? A credit card. You took a credit card and you did not pay the bill. That'll get defaulted. Yashanandani, if you're there, you can unmute and you can probably interact as well. But that's something that we'll have to also keep that in mind. So an FLDG is primarily structured so as to ensure that the first losses in that portfolio or in that loan pool are basically, if they're defaulted, then that's guaranteed. Does not matter that what is the type of that credit which is there, right? So a typical revolving line of credit, yes, would be allowed only by credit cards, and credit card is something that we are not discussing is not relevant for fintechs, because fintechs are trying to structure their products on a transaction credit model nowadays after the DLG era. So every transaction they are trying to structure, they are trying to give a credit for that. Let it be your dosa on a Swiggy, or let it be your new headphones on Flipkart. So I hope I've been sort of able to answer that to an extent.
Right. Thank you, sir. I think, yeah. Okay, I think Yashunandani's clarified that in the chat box, sir. I think now moving on to our next question. Anjali has a question. She says, how does the economy factor into influencing the demand for digital lending services? And in an instance where there is a high growth and an increase in disposable income, why would people in fact prefer digital lending systems? And I think this is a question that is very relevant in today's time and age. So for example, a product like a Lazy Pay or a Simple is only for those people. And I think even the philosophy behind these apps in the first place was to tap into that crowd which is young to credit. So for example, me right now, I'm not earning anything. So I'm not eligible to get a credit card. So I'm not exposed to that credit line itself unless I become a salaried individual. And
Correct.
apps like Simple and Lazy Pay have sort of burst that bubble and come up and said that, boss, even if you don't have an income, it's all right. We can still introduce you to credit. So I think Anjali's question is relevant in terms of the future prospects itself of the fintech industry.
Right. And I think like the inherent answer to Anjali's question does lie in her answer to her question lies in her question itself, wherein she's saying that if there's high growth and high disposable income, why would people prefer digital lending? Is probably because the more people have money, the more they in the attitude to consume, right? The propensity to consume in an economic sense of things, and the more you are garnered towards taking a loan for something, because that's a consumer behavior that has been observed, and we as lawyers would probably not be able to testify that as much as probably data scientists would. But yes, that's how the trend has always been seen, that more people have money, at least in the first segment of a quantifiable thing. So for example, you're just earning 20,000, now you started earning 40,000, your consumptions will go up rapidly, whereas compared to what you were earning probably 2 lakhs, but now you're earning 4 lakhs a month, maybe your consumptions are not going to change that much. So, and that's what the data science field is there for, right? But primarily the new to credit segment, right? The all the already existing 5% are probably in that above 40,000 or 50,000 INR per month segment, correct? But the newer ones which are coming in, they have the propensity to consume a lot, especially given the uh, social media and also the increasing needs of folks are everywhere. So that's where you can always expect people to, buy more, and sort of, the digital lending ecosystem to keep on pumping up every time, all of these things keep on getting more readily available to folks. But yes, again, that's a very economic question, a very policy perspective question. And the answer always lies to the fact that the more income that you have, the more your propensity to consume.
Thank you for that answer, sir. Anjali, does that clarify your question? All right. Great. I think so. We have time for one more question. So maybe Harsh, because he has his hand up. Harsh, would you like to ask your question?
Good evening, sir.
Hi, Harsh. Good evening. Yeah.
This has been an insightful session so far. So, sir, as you earlier mentioned, FinTech is an amalgamation of financial and technology. So, where there is a tech, there is always a cyber threat. It can be in form of identity threat, money laundering, etc. Last year, we also saw a Wazir X case where they were accused of predatory lending. So, from legal perspective, what has been done and what can be done according to you to address the issue of cyber threat in fintech sector?
Got it. So, so one of the instances that you pointed out was predatory lending. A lot has been tried to be, the aim of the digital lending and guidelines has to be to curtail a lot of predatory lending which was taking place. So that's there. The IT outsourcing guidelines, as I was mentioning, and the data localization norms are sort of geared towards ensuring that the customer data is sort of handled with a huge amount of sensitivity around it, while ensuring that it does not get leaked or sold on a black market or whatever, to the detriment of the customer. Also, the factor that once this new privacy bill which has been tabled, if it fortunately sees the light of the day, then in that case we'll have even better enforcement mechanisms, even better privacy safeguarding mechanisms which will be there. Another concept which is there from GDPR, which is very, very important, is something called as privacy by design, right? Or PBD. A lot of so-called European lawyers would refer to. So PBD aims at ensuring that your product is ideated and concepted while keeping in mind the customer's privacy in hand, right? So that's a very huge amount of sensitivity needs to be developed in the Indian ecosystem, in the Indian fintech ecosystem today with that. And of course, some critics have also sort of pointed out that there's been some relaxation given in the new privacy bill to startups, which can, go very antithetical to this whole concept of privacy by design. But again, that's very debatable in a policy way. But yes, that's something that one has to address from a policy point of view. From the own behavioral point of view, a lot of product teams now have started thinking, and for good, that what would happen if that product was something that they were actually personally consuming, right? Because their data would also be subject to whatever they are thinking from, and that's a huge counterintuitive way of making a product, by the way. Because when you're making the product, you're thinking that you are always the seller of the product, you're not the consumer of the product. And for people who are into that mindset, right, for them to bring on this mindset and then think about it, lawyers have also got a lot of role to play in terms of sensitizing them about different best practices that can exist, right? And how can you feasibly, while ensuring your customer acquisition cost and operating cost, OPEX and everything remains low, you still keep on complying with, in essence and spirit, the so-called best practices or moral high grounds that one can take in the sense of privacy and data protection. So I hope I've been able to answer your question to some extent. But yes, having the lacuna of not having a bill just disables anyone to probably answer this question very effectively. Yes.
Thank you, sir. Thank you. I think Harsh, does that clarify your question?
Yes, absolutely.
Thank you so much. I think so. With that, on that note, I think we can end the session for today. First of all, I'd like to again thank you for taking out your time. I know you've been pretty busy, and over the conversations we've had over the past few weeks, I think you taking out time for us has really been a great thing. So really, thank you so much for that. And
Thank you
for the
so
viewers,
much.
I think we'll be also circulating a Google form for to hear feedback on how the session was and how we can improve as a center to disperse legal information and legal knowledge through this platform. So for the viewers, I think we'll be circulating a Google form for feedback. And apart from that, we'll also be issuing certificates to everyone who has attended this session. So I think while you guys have already always, I mean, the biggest incentive to join such a session is always the knowledge that people like Amit sir can give. But the certificate is also there for the participants as well. So I think on that note, Amit sir, thank you so much. It was really a great session, and I hope everyone has learned something. And if not learned, I think have been inspired enough to go and learn and read on fintech a bit more after this session. That is ultimately what LexTech strives to do. It strives to inculcate curiosity in these 5 areas of law: AI and law, fintech, tech law, TMT, online gaming, and other such areas. So I think on that note, I'd just like to sign off by saying, meet us at the crossroads of technology and law, and stay tuned for more such content. So thank you so much, Amit sir. Thanks, everyone.
Thank you so much, Nikhil, and everyone else there in the team. And also, and I've been getting a lot of DMs and a lot of requests from the student fraternity at NLUO. So thank you so very much for that warm invitation and everything that flowed along with the session. I look forward to being able to help out of by all means possible to anyone in the student fraternity. And it's always very very insightful, as well as very nice to interact with the student bodies through these talk sessions. The other good thing is this, that the LexTalk magazine, which is going to come out, and so very eager and look forward to sort of receiving editions for that. And I think that's going to be pretty much a very good thing in a way that it can probably people can now start thinking from a product mindset, and while ensuring that the first principles in law is something that they know at the back of that. Yes, again, and thank you so very much, everyone. Yeah.
Thank you so much.
Thank you, sir.